All right, welcome back to the channel. Today we're going to be going over O'Reilly Automotive, ticker symbol ORLY. And we can see from the 5-year chart, similar to AutoZone, it has been ripping over the last 5 years, up 216%. And from the COVID lows, got down to about 260. We're up almost 300% from the COVID lows. O'Reilly's is the second one we're going to do, and then we're going to do Genuine Parts Company next week. So if you're interested in that one, please like, subscribe, and yeah, we'll go over that one next week. So going into their Q1 release, and we can see that they had first quarter's comparable sales growth of about 10.8%, 15% increase in first quarter diluted earnings per share to $8.28, and they opened their 6,000th store. So I believe O'Reilly's actually has a a larger market cap than AutoZone. If Google is correct, we got 54.51 billion versus 43 billion on AutoZone. So yeah, slightly higher market cap for O'Reilly's. Let's go into the financials, and we can see right away that they have traded kind of between a bottom line yield of like 4% to 8% over the last 10 years. They've had a pretty solid growth over the last 10 years, just like AutoZone has. Yeah, just don't buy advanced auto parts. That's that one got tanked recently, so yeah, that's fun. So bottom line growth over the last 5 years is about 12.37%. They've been doing buybacks about 4.62%. That's also something they mentioned in their latest quarterly release, and if I can find it here, yeah, we got share repurchase program, and it looks like they repurchased 1.4 million shares of common stock at an average price of $8.19 for a total investment of $1.1 billion. So $8.19 is actually pretty dang good. I mean, considering short term for the last 6 months, $8.19 was pretty good buy price for their share repurchase. Yeah, so they are also going to be a huge repurchaser of shares, just kind of cannibalizing their total fully diluted shares. In 2013, they had about 111 million shares outstanding, and now they have 62 million. So almost cut that in half. Probably, 45% cut in share count. So a lot of their EPS growth over the last 10 years is going to not only be from kind of opening new stores and growing revenue, growing bottom line numbers, but also the massive amount of shares that they have taken off of the market. So looking at their income statement, you can see solid growth over the last 10 years. We'll see if their margins expanded or just maintained. SG&A and operating expenses kind of floated up just with the growth of the company. See the massive buybacks in shares over the last 10 years, and EPS diluted per share has been growing very, very, very nicely. Over to the balance sheet, let's see. Yeah, growing long-term debt, which I'm guessing, well, they also have capital lease obligations as well, so they might have a mixture of properties that they own for their stores and ones that they lease outright. Cash on hand is pretty dang low. Long-term debt is 6 billion, 6.7 billion, looks like. So that's interesting. Yeah, I'd have to get more in on that and really look at their balance sheet to see what type of short-term liquidity they might have. So free cash flow statement, we can see operating cash flow increasing. Yeah, stock-based compensation is not that crazy. Have a decent amount of capital expenditures and investments in property, plant, and equipment for just opening new stores. Free cash flow increasing nicely. SBC, like AutoZone, is pretty low compared to free cash flow overall. And then we can see that they have been doing a decent amount of common stock repurchases. I don't think they have a dividend, but they are also paying off debt as well. So going over the ratios and metrics, We can see they've actually had, it looks like, some pretty steady bottom line margin expansion over the last 10 years, going from about 10% to 13, 14% in net profit margins. Let's see, operating profit margins from about 17% to 19%. So a little bit of growth, small, slow uptrend there. Let's see, enterprise value versus market cap. Not a ton of debt on balance sheets. Actually, a bit of debt. Common stock repurchased. Yeah, they're taking out probably almost 1 to 2% per quarter almost in buybacks. Per share metrics, yeah, that's what happens when you have decent growth and then you're also repurchasing 5% of your float every single year. You get some really good per share metric growth. And you know what? I should probably make a graph that shows percentage of per share metric growth. That would be interesting. So actually, I might have that right now, right here. EPS growth, yeah, pretty much EPS growth. So 7%, 32%, 31%, 11%, 27%, 18%, 17%, 24%, 21%, 26%. So man, they typically range, it looks like, between, I don't know, maybe 15%, 20% average on the EPS growth. And yeah, that's pretty dang good. So they're probably getting about 12% bottom line growth, and they're reducing share count by 5-6%. So it all adds up. Dilution buybacks, there we go. All right, so with that being said, let's see if there's any insider ownership. What have they been doing? Awards, maybe one small sale, but mostly just rewards and or awards to the shares. And let's go over to the evaluation template now. All right, so here we are at the evaluation template, and you know what? I put the numbers together on this, and it turned out to be pretty similar to AutoZone, honestly. So we're targeting a 12.5% CAGR with a 2.5% margin of safety. Target rate's going to be about 15%. Although AutoZone, I think, had a little bit better, balance sheet. If I remember correctly, they were a little bit lighter on the debt. So for the end yields, I wanted to have my spread basically between 4 and 8%. I think for AutoZone, it was about 5 to 10%. So for the very bullish case, the end target yield was 4.21, and for the very bearish, it was 7.8. Bottom line growth was 12%, and then I gave about a 2% buffer just in case they could, outperform what they did previously. I wouldn't really expect that to happen. I think it's most likely that, they kind of do something between the, 7 to 10% range, probably maybe 8-10%. So we'll do a little bit larger scenario change right there, and we have bottom line growth from very bearish of 7.5 to very bullish of 14.37. Dilution is going to be at about 3.45 on the very bearish scenario, or 6.62 in the very bullish scenario. If we go back to their dilution or their buybacks over the last 10 years, we can see that they're typically ranging between about 4 to 7%. So we have 9.9%, 4.55%, 4.27%, 4.7, 7, 8, 5, 4.3, 6.5, 6.68, 3.95. So it's probably a pretty decent spread. I think in the base case, we do most likely see about 4% buybacks, similar to the average that they've had over the last 5 years. Very bullish case is going to be 6.62% buybacks, and very bearish case is going to be 3.45% buybacks. Okay. For the EBIT yield spread, we've got a spread between 3.14 to 1.8. Net yield spread, very bearish is 2.98, very bullish is 1.7. Free cash flow yield spread is 3.88 to 2.22, with the average yield spread for the very bearish of 7.8 to 4.21. Putting all of that together, we kind of get a fair value range right now of between 517 to 816. So when they were doing those buybacks at what, 8.19 or whatever, we're probably, you could say they're like, that's a good argument to being fair value currently on a base case scenario. So yeah, seems like pretty reasonable buybacks. I definitely would want to know a little bit more about their buyback structure, but it seems like those buybacks were pretty decent valuations. So all that together, we have a very bearish price of buy point of 440, bearish buy point of 563, a base case buy point of 733, bullish buy price of 971, and a very bullish buy price of 1313. Our 5-year targets in the, let's see, very bearish scenario would be 885. In the bearish scenario would be 1134. In the base case would be 1475. Bullish case would be 1953. And very bullish case would be 2,642. If we look at our total revenue growth over the base case, it gets us to about 4.5 billion in EBIT, 3.6 billion in net income, or 4 billion in free cash flow. So that would be, you know, pretty decent, but like, I think it's totally doable. So a lot of the you know, equity price increase from the stock is going to come not only from, you know, slight like low double-digit growth or high single-digit growth, but a decent amount of buybacks as well. So that's what I got for you guys. Hope you had a great day, and we'll catch you next week when we do Genuine Parts Company. See you later.